Hello everyone, good evening. Today is March 6th and let's continue reviewing what's happening in the market. Over the past few days, we've been repeating the same strategy. Short the rallies. Every time the market pushes up toward resistance or into the highs, that's where we look to lean short. Don't be afraid to take the trade. As long as the broader trend hasn't changed, even if the timing isn't perfect at first, it's usually just a matter of time before the move plays out. Yesterday, we also reminded everyone that near the highs, it made sense to start building some short exposure. Personally, the performance on my side has been pretty solid so far. I often share some of my own trades as well. My short positions are placed on perp decks, so I can't display them the same way you would on a traditional brokerage platform. The only way to show them is through screenshots just to give everyone a rough idea of the position. And remember, these positions are live and constantly moving. What we share every day on this channel is fully aligned with our market view and our positioning. There's really nothing mysterious about that. Of course, anyone is free to challenge the analysis itself. You can disagree with the market view, you can look at my positioning and judge whether it makes sense. Some people might even question whether the trades shown are actually mine. But what you can't dispute is the consistency of the analysis. Every video on this channel is still there, nothing has been deleted. You can go back and review them anytime. In each video, we lay out our market framework, our thinking, and the specific strategy we're using very clearly. Let's continue with today's market action. Picking up from yesterday's move, after the market staged a rebound, it rallied back up to the previous high area. Once price reached that prior high zone, there was no breakout. Not even a fake breakout, and it rolled over. Now remember something important in technical analysis. Support and resistance are always zones, not a thin line or a single exact price. Sometimes the market reacts at a very precise level, but most of the time it's a range or zone. So when we analyze this, we need to zoom out the chart a bit and look at the bigger structure. The key question becomes, did price actually break through that resistance zone? The answer is no. Price failed to hold above that zone, and once it failed there, that's where you can decisively open a short position, even if you didn't short the absolute top. For example, let's say you didn't catch the exact high. When this bearish candle drops, many traders start hesitating. They think, I already missed the top, what's the point of shorting now? But this is where market structure matters. As we've been explaining, the market has been trading inside a range, a box consolidation. When price reaches the upper boundary of the range and fails to break out, that already tells you something important. Earlier, around this level, we didn't short immediately. Why? Because the market could still pull back and then attempt another breakout. So where is the real entry? The moment this key candle gets completely engulfed. Once that happens, the rebound attempt has clearly failed. At that point, the market has effectively confirmed the failed breakout. And that's where you can confidently open a short position. From that entry point, you still have plenty of downside room and potentially even more space below. That's why this level becomes a very high quality short setup. Everyone should pay attention to this kind of structure next time. Previously, we also talked about another signal, long upper wicks. When you see those near resistance, they often signal rejection, which can also be a place to initiate a short. And if you zoom out to a higher time frame, you'll notice something interesting. This area also forms an upper wick on the daily chart. Look at these two locations. They're actually very similar structures. When viewed across different time frames, you can see that the pattern is essentially the same. Alright, let's talk about what could happen next. Some of you might feel like every time we analyze the market here, it seems like we've been getting it right. Let me add a quick disclaimer first. So far, the calls have been accurate, and the strategies we've shared have worked well. But there's an important point. We don't try to predict the market. Markets are inherently unpredictable. What we focus on is executing the correct trading actions, not forecasting the future. Now, fundamentals are different. To some extent, we can analyze and anticipate macro developments, things like the political environment, policy direction, or how events may unfold after a black swan shock. From that, we can infer a probable logical path. But the exact market price path, no one can predict that. Anyone telling you things like price will definitely bounce at this level or at this exact time the market will hold at this exact price is essentially making a bet. They're not only gambling with leverage trades, they're also gambling on something else that if their guess happens to be right, it will generate huge traffic and attention. In my view, that kind of approach doesn't have much real value. In the worst case, someone could blow up their own account and at the same time mislead a lot of viewers. So we try to stay as neutral and disciplined as possible. That also means we may sometimes be wrong in the future. Right now, the analysis might be correct, but mistakes can always happen later. That's just part of trading. If that happens, it's important to understand something. We always focus on correct trading discipline, but unexpected events can still occur. For example, we might take a trade in the wrong direction. When that happens, we simply acknowledge the mistake and adjust quickly. One thing I always emphasize is this: whenever I clearly say this is a place to open a position, I will always provide a stop loss level. If there's no stop loss mentioned, you're absolutely free to question it. But if a stop loss was given and you chose not to set it, or you refuse to accept the stop when it triggered, then you should really ask yourself whether trading is the right activity for you. Because stop loss is one of the most important tools in trading. It both protects your capital and helps maximize profits. A lot of people think stop loss exists just to limit losses, but that's actually not the full picture. In reality, proper stop loss management is what allows traders to amplify their long-term returns. We'll dedicate a separate session in the future to explain why stop loss is actually a tool for increasing profits, not just preventing losses. All right, let's take a look at Bitcoin. Back to the live chart. Bitcoin has now dropped below $70,000. Yesterday's pullback was also quite significant. What we saw was basically a breakout above the range that failed, right? Because of that, we can now adjust the range structure. Instead of using the previous box, we can extend the upper boundary of the range to yesterday's high. That effectively redraws the range box like this. If yesterday's move had successfully held above the breakout, then the original range would remain unchanged, and we could say price had truly broken out of the range. But since the breakout failed, the structure now becomes a wider consolidation box. Let's continue with the view we discussed yesterday. Yesterday, I mentioned that the current structure in Bitcoin looks very similar to the consolidation phase in 2022. Back then, the market formed a prolonged platform before the next major move. Right now, the consolidation we're seeing could actually last even longer than that period. In other words, we might be seeing one consolidation platform followed by another extended range after that. That was the scenario we discussed yesterday. Once you understand that framework, the key takeaway becomes clear. This is not the time to go long. Right now, long positions are not advisable, and even spot positions shouldn't be built aggressively at this stage. However, if you already hold spot positions, you generally just hold them, and if you're stuck holding other altcoins, the same principle applies. You're likely still holding through the range. Now let's talk about the current correction. Personally, I think there's still a scenario where after this recent upward push, the market could have formed a slightly higher move before rolling over. Ideally, the most perfect bearish setup would have looked something like this. Price breaks out of the range, pushes a bit higher toward this level, and then reverses sharply downward. That would have been the cleanest bearish structure, but what we're seeing now isn't quite that perfect. The breakout above the range wasn't very strong. Price only moved slightly above the box before falling back inside. So the bearish scenario still exists, but the structure is not as clean as the ideal setup. There is another possibility as well. This false breakout might simply fail completely, meaning price won't push higher again. Instead, the market could chop around below for a while and then eventually move lower to search for the next consolidation platform. That scenario is definitely possible. However, based on my current assessment, the highest probability outcome is that Bitcoin returns fully into this range. Let me stretch the chart out a bit so it's easier to see. When you look at it this way, it becomes clearer. The most likely scenario right now is continued range-bound trading inside this box. Price will probably oscillate back and forth within the range. Exactly how it moves inside the range is unpredictable, but the key point is that the market is likely to remain inside this consolidation box for now. So when we talk about medium probability events, we need to look at the fundamentals. What might happen over the weekend or actually within the next 1 or 2 months? First point, the war will continue, right? The war will continue. Don't believe what Trump said about the war possibly ending soon. That's impossible. It's very difficult for it to end quickly because the objective hasn't been achieved yet. The objective is not simply to assassinate Khamenei. The real goal is to make Iran, especially in the Middle East, become a puppet regime under their control. That objective has not been achieved yet, right? So it's impossible for things to end that quickly. Second point, what does Bitcoin follow? Yesterday, I mentioned that Bitcoin tends to move with US software stocks or software ETFs. If the software ETF rebounds, Bitcoin usually rebounds, and if it falls, Bitcoin might fall as well. But today, software stocks rebounded while Bitcoin didn't follow. What I actually want to emphasize is not just the software ETF itself, but the broader category of high growth US stocks, software companies, chip makers, semiconductors, and so on. The investors in those sectors overlap quite a lot with Bitcoin investors. So, how will the US stock market move in the future? There's not much to say here. Right now, the US market has already fallen into a quagmire under the shadow of stagflation. So, everyone, what is the medium probability scenario going forward? It's that the market breaks down directly. On Monday, when the US stock market opens, if things go slightly wrong, it could break down immediately. That's a medium probability event, and medium probability events are something we must pay attention to. Now, of course, there are also low probability scenarios. For example, if suddenly over the weekend there's some bullish news, the US stock market rebounds and then Bitcoin starts to rebound as well. That's the low probability case. So, how should we think about the market now? We understand that Bitcoin is still in the middle stage of a bear market, and this phase hasn't finished yet. A large scale rally is unlikely. However, small rebounds are possible. For example, a daily level rebound. It could bounce back above $75,000 or even reach $80,000. Is that possible? Yes, it's possible. That's how bear markets behave. They rise quickly but fall slowly, right? But all of these are still low probability scenarios. So what should we do now? All right, listen carefully. Whether it's Bitcoin or Ethereum, here comes the real key point, the practical strategy. From this point on, as long as the price rebounds to the area near the top of this range, you should look to open short positions. We just expanded the box to this new high. You don't have to place the level exactly at the very top. You can set it slightly lower. That way, if the market forms something like a fake double top, you'll be able to catch the opportunity quickly. In short, don't keep moving the level all the way to the absolute top. So remember the strategy from here on. Once the price rebounds near this high, watch for certain signals. For example, a long upper wick, another long upper wick pattern, or even a bearish engulfing pattern. Let me explain what engulfing means, since some people may not know. First, there's a bullish candle, then comes a bearish candle. If that bearish candle drops and covers more than half of the previous bullish candle, that's called an engulfing pattern. If you see this kind of engulfing pattern or any other weak or bearish structure, then open a short decisively. So the rule is simple. If price comes up to this area and forms unfavorable patterns, short decisively. But if what appears are things like small doji candles, small bullish or bearish candles, or sideways consolidation platforms, then just watch it. Don't rush to trade. However, if you see patterns like this, for example, a bullish candle followed by a bearish candle, that's when you should decisively open a short position. Why? Because as we said earlier, whether you analyze from fundamentals from the medium-term market structure or from technical analysis, they all support the same conclusion. The strategy right now is still to short at higher prices. But the question is, where exactly is higher? Some people ask that. The answer is around the upper area of this box, the upper zone of this range. That zone is a very good short entry area. Now, if the market doesn't reach that area, what should you do? Then you simply wait, or you wait until the price breaks below the box, and then you open a short. There's no better opportunity than that. It's not about gambling here and saying, teacher, since you're so bearish about the midterm market, why don't I just short now and hold it? No, I just mentioned earlier there is something called a low probability event. What if that low probability event happens and the market rebounds to $80,000 or even $90,000? Can you hold that drawdown? That's why we must trade according to setups, not gamble on predictions. Trading is not gambling. This is not like sitting in Las Vegas playing blackjack. It's a completely different concept. All right, that's it for today's sharing. Over the weekend, we'll watch how things develop. If the market changes drastically, we might come back with another update. If not, then we'll see everyone again next week. Okay, that's all for today. See you next time.